Hello, everyone. Thanks for joining us today. I'm Doug Bennett, Acting Director of the New York Tech Alliance. And in a few minutes, Paul Ellis, Managing Partner at Paul Ellis Law Group, will begin today's event and introduce our esteemed panel. Before Paul begins, I have a few items to share with you. Please know that we record our events to share with anybody unable to attend. Recordings are posted on NYTA's YouTube channel. To view this and past recordings, you can go to youtube.com/New York Tech Alliance. And for anyone joining us for the first time, the New York Tech Alliance is a nonprofit serving the New York Tech community. At the core of our mission, we drive access, equity, and inclusion to make the New York Tech ecosystem the most diverse and dynamic in the world. To learn more about us and how to engage, visit our website at nitech.org. And thanks to our annual sponsors who help make events like this one possible. Each has a presence on our website. You can learn more about them and how they support our community by going to nitech.org/sponsors. And a special thanks to GSD Solutions and their team for providing today's event platform, as well as technical and production support. You can learn more about GSD and how they support our community by going to nitech.org/sponsors_GSD_solution. And lastly, we love and welcome support to help us produce and deliver our programming. 3 ways you can help include add a donation when you RSVP to one of our events, become an individual or corporate member of the New York Tech Alliance, or simply make a small donation. You can do that by going to nitech.org/support_NYTA. And with that, I'd like to introduce Paul Ellis, Managing Director at Paul Ellis Law Group, and one of the founding members of the New York Tech Alliance. Hey, Paul, thanks for being with us today and organizing a great discussion and panel.
Doug, thank you, and thanks to Tech Alliance and to GSD for their support for this event. Welcome all. Really excited to be here for this event today. A really important topic. Again, my name is Paul Ellis. I am a board member here at Tech Alliance, and I run this series of events on legal issues for startup companies. For those who are regular attendees of these series, you'll know that we put on events on various legal issues for startups, including financing like this, angel finance as well, formation, intellectual property protection, how to pitch to investors, M&A exits, and other relevant topics. Today, our topic, surviving and thriving in the current climate, VC, venture debt, and alternative strategies. And I'm really pleased that we have a really great panel today for this event. We have Hillary Bush, founder and CEO of Pollen, Amanda Herson, partner at Founder Collective, Alan Wink, Managing Director, Capital Markets at Eisner Amper, and Kevin Zidane, Managing Director, Originations at Trinity Capital. So in order to get started, we are going to quickly go around the screen, as it were, giving quick introductions for each of us, and then we will jump into the content. So again, my name is Paul Ellis. When I am not doing Tech Alliance events, my principal occupation is managing partner of Paul Ellis Law Group. We are a 12-person boutique firm that does a lot of work with startup companies, tech and tech-enabled companies, and venture capital funds. Our clients are looking to us to give them cost-effective solutions to their legal needs so they can focus on building their businesses. In addition to finance issues like we're discussing today, we handle the life cycle of issues facing startup companies, including formation, IP protection, employment agreements and equity plans, general operational matters, and M&A and other types of exits. Our attorneys all come out of top law schools and major firms, giving us the ability to provide high-level expertise with the personalized attention and cost structure of a boutique. In recent months, we've had a lot of clients coming to us that were previously working with the larger tech law firms, Given that our rate structure is roughly 50% that of the big firms, they have found that our combination of startup and venture capital expertise, together with a reasonable cost structure, makes us a very compelling solution at a time when they're looking to manage their budgets. If you'd like to speak with me further, feel free to reach out by email or check out my Calendly link for office hours. With that, I will turn it over to Hillary. Please take it away.
Thanks, Paul, and thanks everybody for joining us today. My name is Hillary Bush. I'm the founder and CEO of Pollen. We are a professional membership that powers independent careers. We work with freelancers that do creative services for businesses. So think copywriters, marketers, designers, etc. And we give them access to the business resources they need and a powerful private network of collaborators and referrals and mentors. My background, really grew up in startups, have always been very passionate about giving people the keys to their own economic outcomes. And through my own experience freelancing and seeing the Wild West out there and the lack of education and resources, I decided to build Pollen. And you can find us at runpollen.com. We're a seed stage company. So relevant for this group and conversation, we've raised $4 million in venture capital, are lucky to have Amanda and the Founder Collective team on our cap table. She did not pay me to say that, and happy to
share the lucky
our
ones.
but yeah, thank you everybody for coming, and thanks for having me.
All right, thank you, Hillary. Amanda, let's go with you.
Sure. I'm Amanda Herson. I am sitting right nearby Hillary in downtown New York. I am a partner at Founder Collective. We're a pre-seed seed focused fund. We're all founders and operators. And the joy of what we do is getting to work with incredible builders like Hillary and partner with them from the very earliest stages to really support them in kind of navigating those early challenges around building a team, product market fit, and then and really supporting you in raising your next round. So we are stage specific, sector agnostic. So we've invested in many weird and wonderful companies. We've invested in everything from Uber, PillPack, SeatGeek, Hotel Tonight, to Eterneva, which is turning human ashes into diamonds, Embark, which is dog DNA, and everything in between, including businesses like Hillary's, Pollen. And we really see it as a privilege to get to partner with founders and not just write a check. And we are very proud of building an ecosystem in New York for our founders. I always say, a VC can be helpful, but what's far more helpful is stepping out of the way and getting the right founders connected with the right founders. So that's a little bit on Founder Collective. My background, you can read it here, so I won't spend a lot of time in it, but I really kind of grown up in retail and consumer and really look at things ultimately from the end customer's perspective. Why I'm honing in on that is I think in this market, and we'll talk about it later, it's really important to kind of think from the end consumer's perspective. I spent time in kind of big corporate America, understanding that typical American consumer, working at limited brands and Victoria's Secret early in my career, then moved over to the investing side at Highland Capital, investing in retail and consumer brands in Boston. I too had the operating building itch and went back home to South Africa to build and grow, especially retail and e-commerce businesses. Had a lot of fun doing that, and then got lured back to New York in the middle of the pandemic to return to investing and working with founders. So thank you everyone for your time, and looking forward to chatting more.
Amanda, thank you very much. Alan, let's go with you.
Good afternoon, everybody. Paul, thanks again for including me on the panel. It's always fun to participate in your events. My name is Alan Wink. I'm the Managing Director of Capital Markets for Eisner Amper. We're a global accounting and advisory firm with 4,000 people across the US and 6 international offices. One of the unique features about Eisner Amper is that we are actually a private equity-backed professional services firm. We actually took on a private equity partner in August of 2021, the firm of Towerbrook Partners based in New York and London. So that's been an interesting experience for us all. Eisner Amper has been servicing the tech and life sciences, clients for 20 plus years. I was actually one of the founders of our tech and life sciences practice about 20 years ago. And I think we all enjoy the process of working with founders and entrepreneurs and helping them to grow their businesses. And I've always said what we do really well as a firm is we help clients bridge that gap between being entrepreneurially managed and professionally managed. By way of professional background, I actually spent about 12 or 13 years on Wall Street doing corporate finance transactions before I joined Eisner Amper about 20 years ago to help them build a management consulting expertise within the firm. Great to see everybody again this afternoon. Looking forward to our discussion.
Alan, thanks very much. Let's go with Kevin.
Thanks, Paul. And I think I'm going last because I might be the only outsider outside New York. I'm calling you out of my home in San Francisco, California. But wanted to echo the gratitude. Thanks to Paul and Tech Alliance for inviting me to participate in the webinar today. I'm a managing director on the origination side for Trinity Capital. Trinity Capital was formed in 2008. It's headquartered in Phoenix, Arizona. We have people scattered around the nation. In all, predominantly the main tech hub centers are around the nation. We're an internally managed specialty lending company. We're a non-bank, publicly traded BDC, Business Development Corp, which means we are regulated under the Investment Act of 1940, which basically means our mandate is to lend money to U.S.-based, predominantly U.S.-based private companies. In our definition, private companies are VC-backed technology and life science companies backed by not only VCs, but other institutional equity investors. We provide venture debt and equipment financing to these growth stage companies. We predominantly focus on the Series B but we have our share of Series A companies as well. And we work with these companies well until the point where they acquired or go public. We've made about 300 investments since founding. We've got about $1.1 billion of assets under management today, and we're definitely open for business to help companies, reach their milestones and get to either cash flow break even or the next round of financing. So I look forward to being a part of the presentation today and providing some guidance to the founders here.
Kevin, thank you. And again, thanks to you all for joining. I'm sure the participants by now share my enthusiasm for this really great panel that we have. So let's jump into content if we can go to the next slide. So today we've got 45 minutes to cover a lot of ground. It is certainly not lost on anyone in this event today that the startup market looks a whole lot different than it did 12 months, 6 months, or even 3 months ago. There's a lot that's changed. I know from my side, my startup company clients are having a much tougher go raising VC rounds than they were, 6-9 months ago. And when they've identified investor, the negotiation over terms is turning out to be a lot more challenging. For my venture capital clients, they're simply doing fewer deals. Just making fewer investments. And when I speak to them, they tell me that they just see this big gap between sort of expectation on valuations from their side versus the startup companies. So, all in, we have a tough market that we're dealing with. So what are we going to be doing today? So we're going to break this down. We're going to into 3 segments. We're going to start with venture finance, talk a little bit about what the market looks like today, and what companies are doing in this market. How do they identify investors, get a deal closed? We're then going to go to venture debt. Again, a lot of changes in the venture debt market over the last few months. And we're going to talk about what venture debt looks like today, what the availability is like, what the terms look like. If we could go back to the previous slide, please. What terms look like. And then finally, we're going to go to sort of a broader topic of, in light of this, what are companies doing? What are startup companies doing today in order to extend their runway, in order to position themselves going forward? So that's broadly speaking the game plan. We will, if there are questions, you can put them in the chat. We will get to as many of them as we can. I can't promise we'll get to all of them, but if we don't get to all of them, you can stay behind for networking. I think most of the panelists can stay for at least some time between 1 and 1:30 for further conversation. I will note that part of the benefit of the panel, we have a VC through Amanda. We have Kevin, a venture debt specialist. I'm a venture capital lawyer. Alan is a capital markets accountant. But to keep us all honest, we have Hillary Bush, who is a founder and who can tell us that we're all wet and where we have it wrong. So that's there's an important role for everyone here. So with that, let's go to Alan and the next slide for a quick rundown on what the venture market looks like these days.
Paul, as you said in your opening remarks, I think if we had this panel discussion, a year ago, 9 months ago, I think our view of the market might be a little bit different. And it's not all bad. I think, one of the problems when you compare, 22 and 23, we're comparing it to, a couple of years before that were record investment years for the VC industry. So I think, what's going on now, I definitely think there's a slowdown in VC investing. Fewer deals are getting funded, and I'll give you some statistics in terms of worldwide VC activity. In the first quarter, valuations are coming down, which I think for, the VCs on the panel isn't the worst thing in the world. As a result of, valuations coming down, we're probably going to have to deal with some down round decisions, in 23 and maybe 24. I think the most difficult thing for investors is just the slowdown in the exit market. And we're basically seeing a fraction of the exits that we saw in prior years. And a good part of that is that the IPO market has really slowed down and really slowed down to a trickle. I know we're going to talk about it a little bit later on in the session in terms of what's the impacts of the failures of Silicon Valley Bank and Signature Bank and the impact that's going to have on the venture debt markets. Just a couple of stats in terms of activity in the VC market. Q1 of 2023, $59 billion invested worldwide. Q1 of 22, 151 billion. Q1 of 23, 7,000 deals done. Q1 of 2022, over 11,000 deals done. Only a little under, $6 billion of exit value in Q1 of 23. Only 20 IPOs occurred. This is basically a fraction of what occurred in prior years. Just to give some frame of reference, in 2021, for the full year, there were over 2,000 exits, totaling close to 770 billion. First quarter of 23, a little less than 6 billion in exits. The lack of the IPO market makes it difficult for those unicorn companies, to realize cash exits for their investors and for their founders. I think also, VC funds are at the age now where they need to create liquidity both for fund returns and for returning capital to LPs, and that's becoming a little bit more difficult. Fundraising has also, slowed down considerably, but alongside the fact of less fundraising, we've also seen, less investment activity. So there's still a good deal of dry powder sitting on the sidelines. I've heard numbers upwards of $300 billion sitting on the sidelines waiting to be invested. So that's a good sign. So, deals will certainly be getting done in the future. But I think as all our panelists will be talking about this afternoon, I think it's certainly a flight to quality in terms of the type of companies that are being invested in. And I think, good companies, good founders are still going to find capital today. I think it's the marginal companies that are going to have a difficult time in the near future. So hopefully that's a good assessment of what's going on in the market, Paul.
Alan, thanks so much. Amanda, let's turn it over to you to get your thoughts.
Yeah, I think, to build on what Alan's saying is, firstly, don't lose hope. There are still VCs who are very actively writing checks, investing in founders, and there is still a lot of dry powder. I think I was just having this conversation in one of the breakout rooms. I think what's happened at every stage of VC is that the goalposts have shifted slightly. So, before it was, oh, we're happy to write a huge check on an idea. And I think, what's happened now is everyone's a little bit more selective. Everyone is a little bit more focused and a little bit more risk averse. And so I think the expectations at every level have upped a little. So, my kind of advice and recommendations on a more tangible basis are, one, do as much as you possibly can before you go out to raise. And I think, I realize that it's a very tough thing to ask founders to do, especially in a city like New York, where, breathing is expensive. But to the extent that you can do anything to de-risk and push your idea a little bit further, I think that is really helpful, because everyone's kind of looking for grapple hooks and a little bit more to grab onto. I would say, try and think about how your business can be more capital efficient in every way. So, the advice also, if you have already raised, how can you stretch every dollar? How can you cut burn? Because it's probably going to take a little bit longer to raise your Series A. And that's an important point to also raise. Whereas, in the go-go times of, let's call it 2020, 2021, where it took a week to raise, and now it's gone back, it can take 3-4 months to raise. Make sure that you leave enough room in your timeline for that. It was done after the first meeting. Now it's done after the third or fourth meeting. So I think, Hillary can definitely speak to that, but I think it is taking a little bit longer. I think to the extent that you can show any type of momentum, we've gone from this to that, and that really helps. People want to see, some momentum. And I think really important in this market is a path to profitability. So I think the days of like, grow at all costs, buy customers, just get scale. I think really now, I know personally, like I want to understand the unit economics. I want to know, I don't expect you to be profitable from day one, but what is the path to profitability? Because from the VC perspective, I know it's going to be harder to raise your next round. I know that money is not going to be as easy. And I almost, to protect founders, want to know that there is a path to profitability. And I think Series A investors are particularly looking for that. So, I think it's gotten tougher, but I actually think it's an incredible time to be building, because I think, if you raised at the wrong time in 2020, 2021 at a crazy valuation, it is much harder to go out now. I also think if you raise too much capital, you fundamentally, the DNA of the business is difficult to change. And I think if you're raising now, you are more likely to find a VC who is thoroughly aligned with you. You are more likely to hire the right employees who understand the risk, and you're more likely to build a much more capital efficient business. So I would say, some may say it's the worst time. I think it's one of the best times to be a founder. I think Hillary's heard me say this before, but I think everyone's sobered up at the party. Everyone kind of knows what they're doing right now. And it's a good time to buckle down and build. So I've said a lot there, but yeah, hopefully that answered some of the questions, Paul.
That was great, Amanda. Thank you for your thoughts. Hillary, why don't we turn it over to you? I mean, you have the distinction of having closed a round over in the last several months, which is an impressive feat. And I think there's probably some learning that you can give people on that.
Yeah, so for context, I raised a pre-seed a little over a year ago, like right when the door was closing on low interest rates, and then just closed a seed round last month. And so two very different environments to raise in. I think the phrase flight to quality is a very interesting one, because a lot of great companies are not going to get funding. And so I think what I want people to know, if you're going out to raise, is like the process has changed. And it's actually no longer, are you a good company? Founders have to manage the process a lot more. Fundraising is, as Amanda said, is not taking a week or two, it's taking multiple months. You have to essentially kind of like babysit in a certain way. Investors follow up with them constantly, always be top of mind, create a lot more deal heat, create a lot more excitement. And so every kind of flaw or false move in a fundraising process poses a lot higher risk than it did during lower interest rates environment. So I'd say for founders, just be prepared for that. Be prepared for fundraising to take up even more of your time. And what also has changed is investors are a lot less willing to be bold and to dream with you. They have their checklist, they have their archetype that they're working through. They go with what they know, and they want to see the fundamentals do this. I actually think that this is a very good thing in many regards, because it makes you build a better business, makes them make better investments, because those unit economics are important to founders, as well as investors. But just be a lot more ready to do that. Like, get down into the weeds in the unit economics. People are a lot less excited about like the vision and the dream. It still very much has to be there, but you're going to have to check every single box. And the other thing too, there are a fair amount of investors out there who will just have conversations with you to learn, but probably don't have the intent of investing. And so if you're a founder, be aware of that and try and get a sense for that before you even get connected with those investors, to save your time, because you're going to have to spend a lot more time with investors to get them to conviction. So I think the process has totally changed. The qualifications for investment have very much changed. And there is like a flight to quality, but the bar for how much effort has to be put in from the founder side has probably quadrupled. And so there's a lot of quality companies and quality founders, amazing founders, who might not know how to run a process in this environment, and that poses a lot more risk. So for founders, figure out how to run a super tight process, because that's like beyond table stakes at this point.
Hillary, thanks for that. And I'd echo that last comment. I mean, there are many investors I see from talking to my startup clients who are very focused, but everything is taking longer. And if you don't keep the process on track yourself, it's very easy for it to go off the rails at a point when you just don't have enough runway to waste any time. I'd like to focus for a minute on valuation and sort of the discussions and negotiations over valuation, because in talking to both my startup company clients and my venture clients, I find that's one of the biggest issues is getting that right, and perhaps one of the biggest impediments to getting deals done these days. And I'll open that up to anybody on the panel, anyone who'd like to sort of comment on that question.
I'm happy to chime in here from the founder perspective. I would really push founders to think like, what does success look like for you? And I'm sure Amanda's going to nod her head at this. It's not always the highest valuation. Like, that is very easy to brag about when you're at the dinners or the networking events, but it actually can really shoot you in the foot. And I realize that this is kind of funny for a founder to be saying, if you raise it too high of a valuation, especially in this market, you're going to have a lot more to show down the line. And that's just going to be harder to get when it's more difficult to extract money from people's wallets. So as a founder, like, make sure you're incorporating that trade-off, and make sure that you are not getting over-focused on valuation and price. And like, success is getting the money. So like, don't torture yourself over valuation. Don't tie it to your self-worth or the actual like value and potential of the company. Just get the money, keep the business going, and move forward. That is the most important thing. Don't get caught up in price or the fanciness of the brand. Get good people, get the money, and go. Also, the other thing too, there are a lot more predatory terms coming out that I've heard. I haven't experienced that. It's not worth it. Like, find the right investors who are able to support you, give you clean term sheets, want to work with you, want to support you as a person. And if you're getting predatory terms, like, know that you don't have to take those, and advocate for yourself as a founder, because I think a lot of investors are going to add those things in this environment opportunistically, and you can push back and you can find something better. So that's kind of how I would come at that.
Hey, Paul, I agree fully with Hillary said. I was just going to add, one other thought to it, in that, valuation shouldn't be the most important thing. And I think, I think Amanda and Kevin could probably comment on this pretty well, is that, not all investors are equal. What's the value add that your investor partner is going to bring to the equation? What can they bring to your company? What relationships can they bring? What can they do to make your life easier? How can they help you strategically? I think those are all the things that you want to consider when you look at taking money from an investor. And valuation, I don't think, should be at the top of the list. It's important, but I don't think it's at the top of the list.
And
Alan,
I think,
yeah, go ahead. Yeah.
sorry, to pile on there to Alan and Hillary, I think that the key point here is also really around alignment, and asking you, the VC, the questions around how are they aligned for the next round? How is their fund structured? Where are they in their raise? Are they actively writing checks? Sometimes VCs get a little caught off guard when founders are asking that. But I think it's really important to understand the expectations also for the next round. And there are a few scenarios here. The one is that, okay, they do lead next rounds. Hillary's heard me talk about this ad nauseum, but, they do lead next round, but everyone's, picking their favorite babies right now. And, the less favored, or the less, the least strong are being left behind. And I think you've also got to be, what's the signaling risk in the next round? Will they do inside rounds? Do they do pro rata? How do they work with pro rata? So I think just going in eyes wide open, in terms of, everyone wants to believe when they invest and when they're raising that everything is going to go well. But because the next fundraise is harder, elbows can come out. And I think it's important to make sure that there is alignment in terms of what goes on, not just for this round, but at the next round. And so, we speak about it a lot, and it wasn't as relevant in the last few years, but as Hillary said, there's predatory terms. There's, funds who are just saying, oh, well, I usually do this, but now I'm not. So just make sure that you kind of ask those tough questions to the VC as well, as when they're asking you lots of tough questions.
Can I add on to that?
Yeah, we have like a minute left, and then we got to switch.
I would just add one tip onto that. If you're a founder and you're trying to figure out if your VC is a good person or not, go back channel them and talk to other founders in their portfolio and ask them directly. Tell me about a time where you brought bad news to this investor, and what did they do? That is a very telling question that hasn't been asked over the past few years, but more and more these tough conversations are going to be happening. And the worst case scenario is having someone who doesn't support you and the business personally, and having someone who will take advantage of that situation and make it kind of a nightmare. So that's just one tip I would add.
So I'm going to make one more comment, then we're going to pivot to venture debt. And I think Hillary's absolutely right. And I say this to my clients all the time, that they really need to be diligencing the investors. And, as Hillary points out, not just the good situations, but the bad situations. What's really important is, how investors been able to work with their companies when things have gone off the rails. Obviously that's not a situation anybody wants to find themselves in, but it's something really important to know about. With that, we're going to pivot to venture debt. Kevin, we're going to turn it over to you to give us sort of an overview here.
Yeah, no, thanks, Paul. I'll start with, venture debt and what hasn't changed. All right. And the design of venture debt, as the name implies, it's for venture-backed companies in technology and life science sectors. And, these are instruments where they don't replace equity. Equity is still the biggest risk taker, and that goes into the company. When to raise venture debt is really, once the company has kind of mitigated some of its risk, It's got some KPIs that are doing well and trending in the right direction. Usually, again, in line with equity, so it's kind of a post-equity instrument to use to further extend runway or to meet more milestones to raise more capital. So that hasn't changed. When not to raise is when you're looking for survival capital, right? This growth capital or venture debt is not, hey, this is not working. We need some debt to kind of give us more time to see if it works. And it's also not good to raise when you're trying to when you over leverage the company. So these are things that have been kind of in the DNA of venture debt throughout the history of it. As Alan mentioned, really this kind of evolution started a year ago as the equity markets started to slow down a little bit. And I would say the biggest changes and what we're looking at, and most venture debt lenders look at nowadays, is a few things. We're still underwriting to the VC. So understanding where that VC is from a vintage fund perspective, and dry powder, and that sort of those questions really make a lot of sense, because most of our companies and technology companies in general are cash burning, high growth companies. So we need to understand, as the company needs to go raise money, can their existing investors and syndicate, and we've talked about this already, have the wherewithal to continue to fund. The other, and Amanda touched on it, it's not grow at all costs. I mean, we're growth fiends. We love growth, and that's if there's a declining or flat business, most venture debt doesn't apply. But over the last year, we're all understanding that it's going to be tempered growth in exchange for better unit economics, sales efficiency, and that sort of thing. So KPIs have really been kind of pushed to the spotlight. The other piece is runway. I mentioned that venture debt is typically post equity, right? It doesn't have to be 30 days or 60 days after. It just has to be somewhat in the rearview mirror where you could kind of tack on to additional runway. I would say, speaking for most of the landscape, you try to come into a venture debt lender with less than 12 months of cash, it's going to be very difficult to get that venture debt. Right now, it's 12 months and higher. I would say some of the banks have moved up to 18 to 24 months of runway before they could kind of fit in their credit box. So that's a key component that's changed over the last year. So and I'm speaking again specifically on venture debt. There are companies that are bootstrapped, that are not venture debt or seed stage, that have access, assuming they're generating revenue, to go after revenue-based, type of financing, right? So it's a portion of either existing or future revenues that a lender could kind of, lend against. I'm talking more about that 4 to 5 year money that's, generally no covenants or limited covenants. So you have that flexibility, you have a period of time to borrow it. And once it's borrowed, you have this kind of, timeline of when to pay it back. So that's kind of the here and now. We're definitely seeing the credit box tightening. The bar's been raised. We've talked about that a few times already. But that's probably the biggest points to bring up at this point.
Kevin, thanks very much. I'll open it up to the rest of the panel. Other comments or observations on this topic?
No, Paul, I agree with Kevin's comments. I think you're seeing a little bit of a tightening in the market for venture debt, and as a result, VCs might have to put more equity into the transactions. But I think you might look, I think if you talk to people at Silicon Valley Bank, they're still in the venture debt business. I think there are other banks that are trying to get into it in a little bigger way. I think I saw on the Wall Street Journal this morning that HSBC just hired a whole group over from Silicon Valley Bank to get into the venture debt business in a bigger way. So I think the venture debt market will continue, but I think it's just a little bit tighter right now.
Thank you for that. Hillary or Amanda, any comments on your side?
Yeah, I would just say, raise venture debt when you don't need it. It really is, an insurance policy. And I think the way that we think about venture debt, it's a really powerful tool. I think, especially in this market where equity is more dilutive, I really recommend and encourage founders when possible to raise debt. But I think know that it is a rainy day, and Kevin, you can definitely, speak to this more, but like what I advise founders is it really is the rainy day or the I have product market fit and I just want to go after it faster versus I'm still in the jungle. So I think just know that going in, but as Kevin said, it's underwriting to your VC. So do it when you're raising, not necessarily when you have like 3 months of runway and I'm not sure it's as much as equity's gotten harder. I think debt is also a little bit more risk averse. So yeah, that's what I would add there.
Yeah, it seems, I mean, generally speaking, the box, the number of companies for which it's the right solution or that will be able to line it up is generally much smaller than to do a venture, to do an equity raise. So there's no question about that. I mean, Kevin, companies that are considering that as an alternative, how do they go about it? I mean, what's the process from your perspective?
Yeah, absolutely. So, what we like to do, I mean, we get our opportunities through a variety of folks. VCs are probably our biggest lifeline. So, if they have venture capitalists on the cap table and they would like their kind of guidance, then having the VCs provide an intro is great, right? Because the VCs know from their other portfolio companies which particular lender work might fit. That particular company. So, kind of going through that channel is great. Obviously reaching out and doing a little bit of research on the sites in terms of which venture debt firms focus on particular stages. There are, venture debt firms that do, again, I mentioned bootstrapped or early stage, seed or Series A. Most venture debt lenders, though, outside that, like to focus on, kind of more of the growth stage. So, kind of doing a little bit of homework on figuring out which venture debt firm kind of fits their particular stage. The other kind of channel is through their attorneys, through their contract CFOs, and then other service providers to kind of help kind of pave the way, and that really kind of, at least there's a connection point and there's a relationship built by those folks, and I think it helps get the attention of venture debt lenders.
Great.
Paul, just to add one other thought, and I think Amanda mentioned it before. I think, the best time to go out and acquire debt is really when you don't need it. And the same thing goes for whether it's senior debt or venture debt in this case. And, as we all know, the cost of capital debt is far cheaper than equity. So if you can raise venture debt, it's a good alternative.
Yeah, absolutely, especially in these sorts of times. All right, so if there aren't any further comments on venture debt, we're going to pivot to our last topic, which is just, in light of this, what are companies doing right now? What are startup companies doing? Obviously, they're trying to raise money or bring in venture debt to the extent possible. It may or may not be possible. And so there are a variety of strategies that companies are entailing. Hillary, why don't we turn it over to you to sort of high-level thoughts on that?
Yeah, I'll approach it from kind of two directions. One is fundraising strategies, which we've talked about a bit, but I'll start with kind of capital efficiency and unit economics. So as capital has become harder to come by and more expensive to get, every single dollar going out the door is more and more valuable. So as a business, any founder out there, I'd really recommend take a hard look at every single dollar that's leaving your bank account and think about, is it worth it? Am I getting more than $1 back from this? And interrogate that, and you're not being cheap or petty. That's like the fiduciary responsibility of you as the leader of the business. So if you are working on any projects that aren't in the critical path to revenue, I would really think about if those are worth it. If you have any vendors that you can negotiate down, do so if you haven't already. If you've let go of employees and you're still paying for their Calendly account or their Gmail account, that $12 a month stuff, it actually matters. So clean all of that up. It's pretty straightforward work. And then I also think adjust your projections for the business. So the markets have changed. Your target customer has probably had a mindset shift. And so figure out if you actually need to switch up your pricing or switch up your go-to-market so that you can acquire people efficiently. My take, having worked at many startups in the past where we have acquired customers very inefficiently, is like, you can't build a business on that ever, but really not now. And so model out like that LTV to CAC ratio from the beginning before you've even acquired your first customer, because that'll tell you what channels to go after. So my big advice here is like battle test all of your assumptions in this new environment if you haven't already. Clean up every single dollar that's going out the door and minimize that and really manage it to the smallest cent and be super efficient with your money, because you're going to raise money and you want that to last as long as possible. The likelihood of pivots has gone up. You're going to want to fund that and all of these types of things. And I also think that that'll set you up really well for fundraising. Even if you're at the seed stage and you're super, super early, being able to talk that talk with investors, I think inspires a lot more confidence in them for your ability to manage the business responsibly. And then the other thing I would say in kind of the fundraising market, leads have always been really important, but now they're more important than ever. So really getting that short list of who your target lead investor will be, making sure that they're actively investing, asking around to see what milestones they're looking at for whatever stage company you are, and really building those relationships way, way earlier than you need to. Go out to coffee, get lunch, get dinner, show up at the events that they're at, and just get to know them in low pressure environments. So you already have this bed of trust that you're working off of. I think that's time very well spent for a very small amount of people. And continue to, hold high standards for the VCs that you choose to work with too. I think this market has become more advantageous to the capital provider side, but that doesn't mean that they can string you along and treat you poorly. So that's just a reminder to the founders out there to make sure to work with good people.
Hillary, thank you. Amanda?
I would just add there two things. I think Hillary said it so well. One is understand cash flow. I think it's something so many great businesses get tripped up on the simple math around cash flow, particularly kind of B2B SaaS businesses, and understanding kind of that flow of cash when it is tougher to just turn on credit or turn on debt. So I would say like really, really make sure that you brush up on those cash flow skills. And I think to Hillary's point, the other thing is build in that culture from day one, from every hire. I'm a huge fan of Sarah Kaus, who bootstrapped her company Swell, and you should read about her. But she said like a huge signal for her was when she interviewed someone and they kind of said, well, I only fly first class. And, she was like, well, you know what, you're not really a fit for this company. And I think just making sure that you're hiring the right people, that they're aligned in terms of their compensation and how they think about that they've got skin in the game, is even more important in this type of an environment. The fair weather employees are not going to be able to get you through the storm. So, pick your people and build that culture of, as Hillary, said, make every dollar count.
Thank you for that, Amanda. Something I'd like to jump in with is, when it comes to financing, and when I'm sort of having strategic conversation with my clients, there's a way that we like focus on like VC funds as the source of financing, but there are other sources of financing out there that, especially in times like this, companies shouldn't forget. There's vendor financing and customer financing. So, if you're out in the market and it may be that you can line up financing with vendors and customers. There's strategic financing, which can come with strings attached that you need to be careful about, but it can also be financing at often more advantageous terms than venture financing. So again, I think these are times when you need to step outside of things have been rolling so quickly, so nicely for so long. one needs to like sort of say, okay, what are the other alternatives that I haven't really been focusing on that might be a good fit for my company. And these are the sorts of things that like everyone on the your accountant, your lawyer, your VC on your board that you're working with, they can all help you with other financing strategies that may help you in a tough time. Other thoughts? Other options?
Maybe I could add both in terms of getting cash and saving cash, right? Getting cash, like you said, there's other sources out there for companies that have assets, AR, inventory. There's asset-based lenders, that could provide that working capital, right? So you've got those that focus on the collateral. They're less concerned about the VC underwriting and some other aspects because they're going to just protect and structure around that capital. In terms of saving cash, as companies look to reduce burn, I mean, if they have venture debt, venture debt components have an interest-only period, right? So, get as long of an interest-only period as you can. And if you have a loan that's terming out, try to do, your part to renegotiate with that lender to extend that, right? So if you could save principal payments from leaving the balance sheet, for a period of time, that's going to help, obviously preserve that cash.
Great, Kevin. Thank you for that. Unless there are other comments, I'm gonna move to a question. So we have one question that's come in. Are convertible notes still good? Is it still a good deal structure for pre-seed right now? Hearing a lot about valuations, not how it's applicable to early fund. Convertible notes in theory don't have valuations unless you consider the cap and note the valuation. So that's really a question about convertible notes as a deal structure. Amanda, Hillary, either of you want to comment on that? Or I can.
I'm not. I'll preface this by saying, like, should not take legal advice from me. I raised the pre-seed on safe notes, which are slightly different, but I think that was a really clean and efficient way to do that. So if you can do that and reduce the cost of the price round, especially in your earliest days, I would definitely recommend that. And watch out for stacking those too much, because those can sneak up on you and you can get super diluted without really realizing it.
Hey, Paul, I think in the the seed and pre-seed area, especially in terms of angel groups around the country, I think convertible notes are still fairly common. And once again, the valuation caps certainly have come down. So, but they are common in the angel space.
Yeah, I will say from where I sit, I agree with Hillary that safes are very much becoming the standard if you're not doing a price round. Back in the day, it was convertible notes, and then it really switched over largely to safes. But you do see convertible notes getting done, less now than you used to. And I think given that convertible notes are a somewhat more favorable instrument for investors, there's a bit of I'm seeing a little bit more convertible note structures than we were maybe a year ago. But yeah, convertible notes still getting done, not like safes are getting done. And the person who asked the question is absolutely right. Valuation is not an issue to the same extent when you're doing a safe or a convertible note. You do have the value, you do have the cap, but the cap is a cap. It's not the valuation. It's valuation is certainly relevant to the cap, but obviously part of the value of using a safe or a convertible note is that you just postpone that whole valuation discussion, and generally the negotiation over deal terms to a later date. You get either of those instruments, safe or convertible note, quick, dirty, doesn't cost you much in terms of legal fees, doesn't take much of your time. You get the money in the door and you move on. So
yeah, I would add to that, Paul. People, whatever cap you raise, say I use a safe, you raise at a certain cap, your subsequent investors will ask what that cap was. So they kind of treat it like valuation. So it's just something to consider.
Yeah, no, there's no question about it. It's not valuation, but it for
Yeah,
sure,
but it is.
it for sure
kinda,
is relevant to valuation. Agreed. One quick last question. The question, what are some of the predatory terms that people are seeing? If anyone would like to comment on this for a minute or so, because we're running out of time. This is maybe a Hillary or Amanda question, but
Yeah, you know, it's funny because I haven't seen many of those terms since I was in kind of growth equity, and I would say we're still not really putting them in, but I think it's really on covering yourself when things don't go, VCs covering themselves when things do not go according to plan. So, you know, I think just, you know, the preference stack, understanding that, being clear on what happens there. You know, at the very early stages, if you completely dilute a founder, I just don't think it's in anyone's best interest, but there are VCs who want to make sure that they can recoup, you know, as many dollars as possible. You know, I think there are things around board structure. Hill, I'm trying to think if you saw any others. I mean, I think you fortunately didn't see many of them. But I think make sure, and we didn't talk about this, but we obviously should in this specifically in this context, Paul, but it's like, make sure you have the right legal team on your side too, so that you know it's wide open what you're going into, because some of it's really tough to understand, and will get snuck in there.
Yeah,
I'll tell you what, go ahead, Hillary.
I will also say that I got very clean, fair terms that I'm happy with. I'd say liquidation preferences. So if you're not fluent in these things, like go watch some YouTube videos, because if an investor puts on like a 2 or 3x liquidation preference, then that actually like you have to pump up the valuation that you exit at in order for you to make $1. So it's kind of like raising at too high a valuation, because the likelihood that you're going to exit at that price becomes really low. Think of it like an expected value calculation for likelihood and then size of exit. And as you get more liquidation preferences or higher valuations on these things, it just becomes harder for you to make money at the end of the day. And then board seats, voting rights, if they dilute you a ton, if you're at a really late stage and they reset your vesting clock, that's actually kind of typical in early stages, but watch out for that later down the line. I'd say get really good lawyers. It's worth every penny. Don't try and do this yourself, and ask around for founders that have gone through this too.
I'll jump in on a couple of things on this. I think, Hillary, you're right. Liquidation preferences, a year ago, everything was 1x. I've seen 2 and 3x, not, which is pretty severe. Other things that I think you need to be concerned about are full ratchet anti-dilution protection. Again, something we didn't see for years. And I've at least seen a couple of term sheets recently with that term. Also, participating preferred is something else you need to be concerned about, where there's no cap on that. I mean, like, we could, and we have spent like entire sessions talking about deal terms. And Alan, maybe you and I should get that panel back on together at some point. A lot of that is more relevant now than it used to be. We are out of time. I'm going to give you each not more than 30 seconds for final comments. Why don't we start with you, Hillary?
No, this has been great conversation. It's certainly made me reflect on my process, and bring those thoughts back up. But if you're a founder out there, you can still do it. Really focus on working with great people. Stay optimistic. Like, it's really hard. So if you do find yourself in a moment of like, oh my gosh, what's going on? Why isn't this working? It's completely normal. Just the only way out is through. So keep doing the good work, and you got a lot of other founders cheering for you.
Thanks, Hillary. Amanda?
I think just, as Hillary said, just educate yourselves and know what the risks are from the get-go, and make sure that you are aligned and understand what you're heading into, because you're going to give your blood, sweat, and tears and years of your life. And you want to make sure that you understand kind of what you're giving up, what the risks are, and what you could be getting.
Thank you. Alan?
I was going to say, I think surround yourself with great people and great advisors, and it'll definitely increase your chances of being successful.
Kevin?
I'll just say that I would be glad to be a resource for anyone on this call. I think the Tech Alliance team will leave our contact information, but if I could help in any way, please call and email. I'll be happy to help.
Thank you, Kevin. Okay, with that, we are going to wrap. First of all, thank you to the panelists. This has been a really great conversation. We covered a lot of ground for an hour, so that's all.